Hi, my name is Dave Greenberg, and I'm here today to talk with you about charitable giving, specifically estate and plan giving. I'm going to talk about a few tools for estate giving and charitable giving generally, and then I'm going to talk a little bit about giving to Horizon House and Partners in Caring in the endowment. I'm an estate planning attorney at 360 Law Group, and I'm a member of the philanthropy committee here at Horizon House. So before we get into the different charitable giving tools, I always like to talk about why folks give to charity. So why charitable giving? So first we can think about what are your philanthropic goals. For a lot of people, it's personal satisfaction. They really enjoy just that good feeling a charitable gift gives to them. Another reason is giving back to the community. Here at Horizon House, you've all received a lot from this community. So giving back to this community is a great reason to give. And whether it be Horizon House, a religious community, a university, whatever community you might be a part of. Then we think about what are your charitable focuses. So it can be arts, health, education, social justice, or again, right here at Horizon House. When we think about giving, we can break it into two different time periods, one being lifetime giving and plan giving. And when we're talking about a larger giving structure, we can plan for both that lifetime giving and the plan giving or the estate giving. Anytime we're making gifts, we have to decide if the donor is going to be anonymous or is going to get some recognition for their gift. If they're going to get recognition, if it's a substantial gift, sometimes there's negotiations of naming rights. Other times it's just whether or not someone's going to get listed in a list of donors that often get published by the charity. Another thing to consider when making gifts is the gift going to be restricted or unrestricted? Charities very often like the unrestricted gifts that can be used by that charity for the area of greatest need. But donors often like to put restrictions on gifts. At a university, for instance, if someone was a member of the biology department or a student of the biology department, they might want to restrict that gift to that university to be used by that biology department. Um, Anytime we're making restrictions on charitable gifts, we always want to talk with the charity beforehand to make sure they're able to accept the gift with that restriction. So those are the philanthropic goals. Those are the reasons to do it that benefit the organization. But we can't shy away from the fact that charitable giving has some wonderful tax benefits to the donor as well. For income tax deductions, we need to be mindful of the fact that the standard deduction for an individual is $12,550 per person. For a married couple filing jointly, the standard deduction is $25,100. So in a given year, you would need to give or have your total itemized deductions be greater than those numbers to have an income tax benefit for a charitable deduction. If you're not giving enough to get that income tax deduction, you still should make your gifts if that's a charitable goal of yours. It's just possible you might not get the income tax deduction benefit. Um, if you give with appreciated assets, you can avoid some capital gains, and there's some ways you can give with your IRAs that can have some tax benefits, even if you're not going to get the benefit of giving in excess of that standard deduction. In a little bit, I'll also talk about way you can make some gifts to donor advised funds, pooling gifts that you might give over 5 or 6 years and give them all in 1 year. And that would be a way to get some additional income tax benefits. For estate taxes in Washington, there's a $2.2 million Washington estate tax exemption amount. For federal purposes, it's an $11.7 million federal estate and gift tax exemption amount. What that means is if you pass away with assets greater than those numbers, you might owe some estate taxes to the Washington Department of Revenue or to the IRS. Any gifts you give to charities upon your death will reduce the estate taxes that are owed. So for example, for Washington purposes, if you had a $3 million estate and upon your death you gave away a little over $800,000 to charities, you would then have no estate taxes owed because you would get a charitable deduction for those gifts. So having talked about some reasons why you would give to charities, we can start talking about the charitable giving tools. Now, one of the main purposes of this talk is to focus on plan giving and estate giving, but I do want to briefly talk about some lifetime giving and some benefits to that. So we're going to go through the various tools, and first we're going to talk about outright gifts during your life. Then we'll talk about gifts, qualified charitable distributions from an IRA. From there, we'll talk about donor advised funds. We can then talk about bequests in a will or revocable living trust. Then IRA giving with beneficiary designations. And then from there, we'll talk about charitable trusts, pooled income funds, and private foundations. So we'll start talking just about the outright gifts of cash. This is when you write a check directly to the charity. Under the CARES Act in 2021, you can get an income tax deduction up to 100% of your adjusted gross income. That's only if you give cash. If you are trying to get the benefit of this 100% income tax deduction under the CARES Act, the donation must be to an operating charity. What that means is you can't make the donation to a private foundation or to a donor advised fund. A gift to Horizon House would qualify for that 100% AGI deduction, as would a gift to the Red Cross or a university or another operating charity. It's just restricted if it's a cash gift to a donor advised fund. Another great way to give during life is to give capital assets. So if you have appreciated securities, let's say you're an early investor in Netflix or Microsoft, and you've held those stocks for a long time, there might be significant built-in gain that if you were to sell the stocks and then give the cash, you yourself would pay the capital gains on that sale. If you instead donate those stocks to the charity, you will get an income tax deduction equal to the fair market value of the shares on the date that they're given. What that means is that the charity would then sell the shares, receive the full benefit of the fair market value, but the charity is a nonprofit, so it doesn't have to pay income taxes. So there will be no income taxes owed on those appreciated stocks. One thing that we do need to be aware of here is if you're giving appreciated assets, there is a limitation on the income tax deduction. It's 30% of your adjusted gross income, but there's a 5-year carry forward. So if in 1 year you make significant gifts, you can carry, and it's significant gifts that are in excess of 30% of your adjusted gross income, you can carry that deduction forward for 5 years. The same idea applies if you were to make a gift of real estate, art, or other valuable appreciated assets. If you make gifts of assets that aren't easy to value, things that aren't sold on an open market, like real estate or art, you would need to have an appraisal to determine the value of the gift. But the nice thing about giving these to charities is that you avoid the selling cost. You avoid the hassle of having to sell those assets. So the next thing that I'd like to talk about is qualified charitable distributions. And this is a gift that you make directly from your IRA to the charity. Unlike taking the required minimum distribution out of your IRA into your bank account and then writing a check to the charity, this would be a gift that goes directly from the IRA custodian to the charity. It's limited to $100,000 per year, but the benefit here is that the amount distributed under the qualified charitable distribution is not included in your adjusted gross income. So it can potentially keep you into a lower tax bracket. You must be 70 and a half or older to take advantage of this qualified charitable distribution. And it must be given to an operating charity. You can't make a qualified charitable distribution to a donor-advised fund. If you are going to take advantage of the qualified charitable distribution, make sure you talk with your accountant and work with the IRA custodian to make sure that the distributions are documented correctly so they will show up on your income tax returns correctly. So speaking of donor-advised funds, even though you're not able to do a qualified charitable distribution into a donor-advised fund, they are great tools. The way it works is you make a gift to a community foundation or the charitable arm of a financial institution. Vanguard has a donor-advised fund. Fidelity has a donor-advised fund. So you can just transfer assets to a sub-account essentially that you've set up in this institution. So let's say you're using Fidelity and Fidelity's donor advised fund. You'll have your own separate fund in there. It's an irrevocable gift to this fund. You then get to direct how the gifts are made out of your donor advised fund to an operating charity. Earlier I mentioned that the individual standard deduction is currently over $12,000. So a lot of folks that are making smaller charitable gifts every year might not be making gifts that are in excess of that $12,000 a year. If, however, you were to, let's say, you want to make $10,000 of donations every year, you could make a $50,000 donation in 1 year to a donor advised fund. You would get the income tax deduction that year because it would be in excess of your standard deduction. And then from that $50,000 over the next 5 years, you could then make $10,000 gifts. So it would be the same amount being given over the 5-year period. You would just front load the gifts to the donor advised fund in year 1. Here, the downside of giving to a donor advised fund is that the CARES Act 100% AGI rule, if you were to give cash, does not apply because the donor advised fund is not an operating fund. And likewise, because a donor advised fund is not an operating fund, you cannot give qualified charitable distributions to that donor advised fund. The succession rules from a donor advised fund are a question that we often get, is what happens after the donor passes away? And this depends on the financial institution or the sponsoring organization. Some organizations allow you to designate a successor advisor who would be the one that advises gifts after you pass away, but it really depends on the sponsoring organization. So now we're going to move into ways that you can give in your wills, revocable living trust, the estate giving, the plan giving. What we've talked to up till now are gifts during your life, ways that you can support whatever charity it might be, whether it's Horizon House or another charity, while you're still alive. Now we're going to start talking about ways you can make gifts upon your death or in conjunction with some documents that might be set up to be effective in one way or another upon your death. So the simplest and easiest way is to make a bequest in your will or in your revocable living trust. In those documents, we think about 2 places to give. One is a specific gift. This is when you say, I give Horizon House $5,000. A residuary gift would be, I give Horizon House 5% of my estate. The specific gift is a little bit easier to administer. You can just simply, the executor of your estate can simply write a check to the charity, and then the charity is no longer part of the administration of the estate. If it's a residuary gift, depending on how the gift is structured, the charity might not know if it has received everything it is entitled to until the very end of the estate administration. Depending on the complexity of the estate, this can be a very long period. It can be 2 years or more. So depending on how much you're giving to the charities, specific gift or residuary gift, there are different times when you would use different ones. Um, if you're giving all of your assets to a charity, then the charities will be in that residuary position because they will get everything that is left over. When we're making gifts in a will or revocable living trust, we have those same decisions about whether the gift is going to be restricted or unrestricted. Here, however, if we're going to be making restricted gifts, there needs to be a serious conversation with the charity up front, where we really talk about how the gifts are going to be restricted and whether the charity is going to be willing to accept the gift with those restrictions. What we like to do is we also like to build in language into the will or revocable living trust that says that if the charity is unable to take the gift with those restrictions, then the executor has the ability to either redirect those assets to another charity or to negotiate the restrictions and make them less restrictive, or find some other way for that named charity to use them. And sometimes, the negotiations are very simple and the charities are very accommodating. But other times, if the restriction is too much for the charity might say that we're unable to take it with those restrictions. And the last point here, that the executor should be given discretion on what to do if a charity has been dissolved or for some reason can't receive the assets. We want to make sure that those assets that are supposed to go to charities, that they actually get to a charity, whether it's the named charity, another one named in the will, or one that is doing similar work to what that dissolved charity had done. In addition to giving from a will or a revocable living trust, a donor can make a gift from their IRA or also from their life insurance, just using the beneficiary designations. Here I'm going to talk more about the IRAs because there's some tax nuances to that I think I'd like to highlight. So the process to do it is you simply name a charity as the beneficiary of your IRA. Upon your death, the charity or a charitable trust can receive the value of the IRA, and they won't have to pay income taxes when they take the distributions. If you give an IRA to an individual that's other than a spouse or a minor child, and there's a few exceptions here, the IRA generally must be paid out to that individual over 10 years. That individual is then going to have to pay income taxes on those distributions over those 10 years. So let's say a $1 million IRA here being distributed over 10 years, that's $100,000 of income that's going to have to be taxed in that individual's on the individual's 1040 over those 10 years. Instead, let's say we give that IRA to a charity and we have other assets that we can give to the individual. The IRA goes to the charities, there's no negative income tax consequences to that, and the individual would receive assets that would most likely receive a stepped up basis under current law. A stepped up basis means that if the basis in an asset is $50, but the fair market value upon death is $100, the beneficiary would receive those assets with the basis of $100. We don't get that benefit when an IRA goes to an individual. So if there are two pools of funds that we can use to support an individual on one hand and a charity on the other, it's always or almost always beneficial to give the IRA to the charity and then give the other assets to the individual, because the individual will have be in a much better tax position if they were to receive the other assets. So moving from IRAs, we can then talk about charitable remainder trusts. A charitable remainder trust is a trust that you set up during your life, or it can be set up in a will, but the general structure is that this is an irrevocable trust. It benefits an individual or two individuals for their lifetime or for a period of years, but the remainder at the end of that person's life or at the end of that term of years, it goes to a charity. So a great way to use this is, let's say there is a married couple that wants some income tax deductions now, but they know they want to receive some benefit from these assets during their life. what they might do is they might set up a charitable remainder, a unit trust or an annuity trust. And every year for the rest of their lives, for both the husband and the wife, they'll get a payment from this trust. An annuity payment or a percentage of the trust every year. Let's say it's 5% of the value of the trust every year. So they get that payment every year. They get to use it for their expenses. And then after the second of them has passed away, everything that's left goes to the charity. Here, we can use IRAs to fund these charitable trusts. So let's say we set up a charitable remainder trust in someone's will. So someone passes away, there's a charitable remainder trust set up in their will. We can put regular assets in that charitable remainder trust, and let's say it's a trust to benefit their kid for the child's life, with the remainder then going to the trusts. We can put an IRA actually in that charitable remainder trust that's been set up under the will. Because a charitable remainder trust is a tax-exempt entity, the charitable remainder trust won't be paying income taxes when it takes those required minimum distributions that we talked about a few slides ago. The IRA would still have to get paid out over 10 years, but the assets could then remain in that trust for the benefit of that individual. So it's a way to get some long-term benefits from an IRA, some better tax position for an individual. It's a little bit more of a complex structure, but if there's an individual who's going to be receiving the IRA and needs to use that IRA during their life, and you want to have some restrictions on it without significant negative tax consequences, this might be a good tool for you. It does only work for those folks that are charitably minded, because there does have to be a significant amount at the end that is left over for the charities. In addition to a charitable remainder trust, there's a charitable lead trust, and this is a little bit of a different trust. It's still a gift to an irrevocable trust, but instead of an individual receiving benefit on the first side of the gift, the assets go for the benefit of the charity for the first portion of the trust life, and then after, let's say, the death of an individual or a term of years, at that point the assets go to the individual. Unlike a charitable remainder trust, the charitable lead trust is not tax exempt. So what that means is that any income that's generated in a charitable lead trust will need to be paid by any income that's generated in a charitable lead trust. Taxes will need to be paid either by the trust or by the donor. So it's a little bit of a giving tool, a different tool, and unlike the charitable remainder trust, at the end of the day, the assets go to an individual instead of going to the charity. So another tool that can result in assets going to the charity after someone's passing is a pooled income fund. This is similar to a charitable remainder trust, but instead of the donor setting up the trust, the charity sets up the trust. And what happens is multiple donors will essentially pool their assets together in essentially a mutual fund that's set up by the charity. During the donor's life, the donor receives the income that is generated by this fund. Some years it might be higher, some years it might be lower, depending on the fund's performance. And then upon the donor's death, the donor's share of that pooled fund gets distributed to the charities. So it's run by the charity. So unlike a charitable trust, the donor doesn't have to get involved in setting it up. They would just have to make the donation to that pooled income fund. The final tool that I'd like to talk about is private foundations. Now these are useful when a donor wants to retain control after they've passed away, and more control than you would have in a trust. A private foundation allows you to essentially appoint a board of directors who would manage this foundation after you're gone. You can set out some general guidelines for them to do it, some types of charities you'd like to support, what your philanthropic goals were, and then the board of directors would essentially manage this foundation and make grants from the foundation that are consistent with your goals. It allows for a lasting legacy, and there can be as much flexibility built in as needed. Private foundations are very costly to administer, much more so than a donor advised fund, or a charitable remainder trust. So the minimum that should be put into a private foundation when we start thinking about whether it's right for someone is a $1 to $2 million gift, due to the substantial administrative costs. And a lot of those administrative costs are there because there are complex rules and regulations that must be followed for this private foundation to maintain its tax exempt status. So while a private foundation is a great tool for some folks, it's not a great tool for all. So with all of those charitable giving tools now having been discussed, and having discussed why folks might be interested in charitable giving, I think it's important to bring this back to estate and plan giving at Horizon House specifically. As you may have heard, February's focus from the Philanthropy Committee is on estate giving. They're focusing on trying to get folks to add Horizon House in one way or another to their wills, trusts, or their beneficiary designations. Estate giving, in one form or another, has been the most important source of funding for Horizon House's endowment. In 2020 alone, Horizon House received over $600,000 of fulfilled estate gifts. And I know that the Philanthropy Office is working very hard to continue that trend in 2021 and beyond, and to have that trend continue going forward. Folks need to add Horizon House to their wills, trusts, and beneficiary designations this year and next year. So, as time goes on, and those wills and revocable living trusts get put into place, the gifts get sent over to Horizon House. So if you have questions on how you can include Horizon House in your estate plan, you can contact Charlene or Ruth Ann at the Philanthropy Office. Their contact information is here on this slide, and I will pause for a moment to allow you to jot that down. And they would both be very happy to talk with you if you have any questions about how to include Horizon House in your estate plan. So it's been my pleasure and honor to talk with you today about charitable giving. It's something that I enjoy helping clients with, helping individuals with, whether it's making gifts to Horizon House or to any charity that might be on their mind, something that they've supported during life. And I think when we're thinking about charitable giving, you can think about those charities that you have supported during your life. And after you're gone, the gifts that you've made during your life, you would no longer be making. So is there a way in your will, a revocable living trust, or other planned giving tool to continue your lifetime giving legacy after you've passed? So I want to thank you very much, and feel free to reach out to me or the folks at the Philanthropy Office here with any questions you may have. Thank you.